Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture with me, Ryan Huang. And we are looking at how the tariff environment is going to have an impact on the Singapore economy. As we see the US continuing to make deals with various countries, Singapore is also trying to do its part. And this is part of its latest update coming through from the Singapore Economic Resilience Taskforce. Deputy Prime Minister Gan Kim Yong saying there's progress on trade talks with the US. While a 10% baseline tariff on Singapore remains non-negotiable, there is hope that the country will be spared from an upcoming sectoral levy on its pharmaceutical exports and possibly also on semiconductors. Well, what is going to be the coming quarters looking like when it comes to growth? We are checking in now with Seng Wun. He is the Singapore Economic Advisor for CGS International. Seng Wun, good morning. How are you doing today?
Good morning. I'm good. I'm still wandering in the cloudy sky, kind of like the economic environment. One day cloudy, one day raining, one day sunny.
Yeah, it has been quite a ride so far this year. And you've also been going out and about, partaking in various economic activities. What is the climate like right now with the backdrop of all the caution that people are starting to feel when it comes to spending, business activities, and so on? Now, you've got all these tariff concerns right now. What are you seeing when it comes to the economy?
It varies. Just like the weather. I remember at the beginning of April when President Trump unveiled his very pretty reciprocal tariff chart and a massive tariff. And then immediately after that, businesses was, I think, in doom and gloom because those were really numbers that could trigger not just recession in the U.S., but will have repercussion around the world, including for trade-oriented Singapore. Roll forward to today, and clearly we had erratic path as far as tariff or just rollback appeared to be a little bit clearer. We have seen businesses holding back orders, front-loading orders, pausing orders, and now with the so-called détente or pause, they're rushing again or just re-looking at orders flows and seeing whether there's enough inventory. Even today, looking at Christmas, for instance, as well. So it varies from company to companies, which clearly not very good from a business who has to plan, with a longer-term view. But for now, I suppose risk of recession may have subsided a little bit, but there's still, I think, a lot of uncertainty about and around the actual growth path or orders flows. But for now, hold on, enjoy that little pause and rush orders, whatever we have to, if they need to. And we saw that, I think, coming back to Singapore in how our trade numbers have performed and how our factory activities has behaved as well. Clearly, on the factory activity side globally, we have seen a slowing momentum on that front.
Yeah, let's talk about the growth projections. So you've got the MTI growth estimate earlier downgraded from earlier projection of 1 to 3%, which was much lower than the 4.4% expansion in 2024. What are you expecting? And are we looking at any revisions anytime soon?
I think we cannot be revising every month in response to just the what kind of tariff announcement will come through. I suppose 0 to 2 for now for Singapore take into consideration, well, at least for the next 6 months, the kind of growth or the impact we may see around the world. And as I said earlier on, we clearly see front loading coming back again because of the pause. So clearly what will happen in the second half will depend on what kind of tariff or news flow on geopolitics, on the trade policy front coming up from the U.S. especially, or whether, very importantly, the pause, especially between U.S. and China, it's still a relatively high tariff, no longer 145% for Chinese exporters into the U.S. side, but it's still at 30%, impact margins very significantly for many. How we progress in terms of trade talks between the two largest economies, and it's not just about trade, because there are other non-tariff issues which are in the way as well, whether it's deal on the TikTok side or whether it is AI chip or whether it's, shipping fees, etc. as well. So there's still considerable uncertainty, which may mean for Singapore, for now, at least maybe for the next 6 months, 0 to 2% is likely to hold. What happens after that clearly will depend on development outside of our control.
Yes. So let's unpack the various scenarios. So we have at least some idea of where things are going. The 10% minimum tariffs will be there. There's some hope that the sectoral tariffs will not come into play, but some experts are saying if it does do so, we are looking at potentially 25% tariffs for pharmaceuticals and semiconductors. How much of an impact will it be on Singapore if it does come to pass?
Well, your guess is as good as mine, honestly. And remember, we're still having President Trump and team talking about unveiling tiered tariff rates or, rates, again, different kind of reciprocal tariff. I suppose for us, really, it's ultimately where and what the pharma company in Singapore who are exporting to what extent those drugs, whether the finished product ends up in the USA or whether the finished product ends up elsewhere. And some of the drug ingredients clearly are headed mainly for the US side for final production, I suppose, into there. It will clearly be a case of to what extent we see some front-loading as far as some of those active ingredients are concerned, or whether we see further deals being possible because ultimately the drug manufacturer themselves will have either absorbed it or pass it on. And it may vary, again, depending on the individual drug makers as well. But I would say, on general, if they were to happen in terms of the different tariff rate, it will still be a case of American consumer having to pay more at some point. In the meantime, we may see businesses taking the hit. We see signs of that in, say, the most recent numbers of the American PPI, Producer Price Index, the indices in which we see some impact on their margins more so than at the retail level. So we really clearly have to see how this play out, to what extent the pharmaceutical companies think they have a sufficient buffer or not to absorb some or pass the rest on, because if the U.S. market is a big one, they may have to give and take in terms of passing it on. And clearly this is what President Trump and administration hope to see in reducing, I suppose, drug bills for Americans by forcing pharma companies to take more of the hit than consumers.
Yeah, Seng Wun, I also want to take a look at the strength of the Singapore dollar versus the US dollar. It's gained 5% year to date. And of course, we've been seeing some weakness in the greenback in recent days. What are the implications of a stronger Sing dollar? I'm imagining it will make our exports less competitive.
Well, again, it's depending on what we export. We can come back to the drugs we're talking about, in that you can't pack up drug companies quickly and reassemble them elsewhere. So, we are not producing stuff that can be cheaply produced elsewhere. Otherwise, they would have done so already. In terms of the currency front, I would say this shift away from dollar assets, US dollar assets, may continue near term. Obviously, more recent news flow has been the credit down rating of US sovereign debt, which caused people to remember that the US is vulnerable on that front. Whether the baton on the tariff front and pullback on more aggressive tariff policy will help the US dollar in the medium terms remains to be seen. But for now, there are clearly a lot of nervous FX traders, investors out there who say perhaps we are better off shifting away or depending less on US dollar assets and move into other safe haven around everywhere around the world, whether it is in Europe or whether it's in, say, Swiss franc or the yen or in Asian currencies and in very safe haven Singapore, where obviously we may stand to benefit more from our neutrality and our more stable and predictable policy implementation and announcement.
Yeah, quite a tough environment to operate in right now, especially with all the uncertainty. And we've been in conversation with Seng Wun. He's the Singapore Economic Advisor for CGS International. Seng Wun, thanks so much for your time this morning.
My pleasure.
Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.